Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 22nd of 2026. So we received several pieces of pretty important news last week, the first of which, depicted in the slide here, is the ruling by the Supreme Court knocking down the Trump administration tariffs, and specifically in this case, we have the IEEPA, which you can see the impact over spanning two different fiscal years is actually fairly impressive. I mean, this is in some cases we're talking like 130 to 170 billion dollars, depending on how you're measuring it and over what period. You can see the Section 301 tariffs, which have been in place for quite some time. In some limited cases, you got Section 232 tariffs, which have benefited the calculus. But the ones that were struck down primarily were these IEEPA. And so obviously the magnitude very well represented here. If we slide over to the right, you can see that before the ruling, the average tariff rate was about 15.3%. Post ruling, when those IEPAs went away, you see the blue sections disappear. Then that goes down to 8.3%. But then subsequent to that announcement, what we heard from the Trump administration was that they were going to impose a Section 122 tariffs, and that they were going to initially impose 10% tariffs, which depicted here, which would brought that average tariff rate from 8.3 to 11.6. But then the announcement on Friday was that the Trump administration was going to increase that to 15%. And so you can see there. So this is obviously the gambit by the administration to replace what's being taken away from them by the Supreme Court. Now, obviously, there's a much bigger question, which the ruling did not address, and that's the issue of repayment. So that's definitely a known unknown at this point. But again, very bold ruling by the Supreme Court. It was a 6-3 decision, so obviously nowhere near unanimous, but it did have the support in the ruling majority from some of those justices that were nominated by Trump. So that's very interesting in and of itself. But again, a lot is being made over the issue of tariffs. In the wake of that, you can see the impacts here. Again, these are all projections, so we don't really know, but we will definitely track. A lot of noise in these particular charts. It just looks at different countries and the individual impacts to some of these tariffs. And you can see here, you've got the pre-ruling tariff rates. Let's just take China, for example, about 37%. In the post-ruling is 21.2. That's in the absence of any new tariffs. But then, as we just discussed, that we have basically these Section 122 tariffs that are going into place. And for purposes of this conversation, since the most recent news headline was that the Trump administration was going to impose 15% Section 122 tariffs, that will focus on the green dot here. So you can see that, the Chinese tariffs, not what they were going to be, but they're still very high. You can see you got Vietnam, 21.6, and in this post environment, they're still 18.8, and you can see some of the other countries we get down here are very close to where they were previously, and in some cases, very interestingly enough, that they're actually higher than the previous tariffs, and that's because this 15% is being applied uniformly across all countries. And you can see here depicted a little bit differently what that average tariff rate, or that what they're calling in this chart a surcharge, is going to look like. And you can see that when you get down here, Mexico, Canada, not as much, but obviously much bigger impact in some of these other jurisdictions. Another piece of big news that we got was the fourth quarter GDP number, and we have two versions of that. So this, the headline number that was reported was that annualized growth in the fourth quarter was 1.4%. That was below estimates. That was actually below the Atlanta GDP Now revised estimate, which was looking for something a little bit closer to to 2, but we knew it was going to be light because we had essentially the government partial shutdown for a period of that time. And so we knew it was going to be a little bit weaker coming off 2 very strong quarters. So the annualized number, just to be clear, taking that 1 quarter and annualizing it, that growth was 1.4%. Now, if we look at the annual change in GDP, and that's taking in stock into consideration here that we do have that fourth quarter data. And so what does 2025 look like relative to 2024? And that overall growth rate is about 2.2%. And you can see here, going back to 2005, the line of best fit here would look something kind of like this. So we're not too far off a trend line, and especially if you kind of discount the aberrations in this data series here, that we're very close to, something that feels a little bit normal, even if that final quarter was a bit of a disappointment. Here we have some of those contributions, and then on the right, we have something that I'm really going to focus in on. So like everything that you're going to hear about GDP growth can be condensed into, I think, what the real gist of this is. You can see here on this side, you've got fourth quarter of 2024 versus fourth quarter 2025. Now, you can probably very quickly spy, the one that has the most consistent impact from one year to the next, and that's going to be consumption. It's going to be consumer spending, and that was positive in both periods, as was state and local government spending. But again, this is going to have the majority of the impact, and we know that consumption overall accounts for about 2/3 to about, call it 68% of total GDP growth. And these other categories, particularly inventories, can be very noisy. Federal government spending, we know, has been off. And of course, trade is a wild card as well. So that's why, in sliding over to here, one thing I want to point your attention to is real final sales to private domestic purchasers. And this really drives at the heart of what GDP is. I mean, this is that 68% of total economic growth. It's driven by these final sales to private domestic purchasers. And you can see that in the solid line here. So amidst all of this noise, you can see, net exports, trade, you can see, domestic investment and inventory. You can see how noisy these other components are. But my focus here is on this net consumption, and that number actually has remained fairly consistent. So, when you look at it from a very broad sense, we've had a tremendous amount of consistency here in net consumption over the last few years. Balance of trade here, trade numbers were weaker than expected. You can see that depicted here. Exports were weaker while imports were greater. And we just talked about consumption, so that's what's driving the import side. And what's interesting in this particular case is you look at this chart, you can see that gold actually had some influence here on the trade numbers. But again, consumption remains strong, so demand for imports, regardless of where the dollar is, and regardless of the fact that the dollar is a little bit weaker overall year over year, then those foreign goods that are being imported are more expensive. Doesn't really matter. Purchasing power is relatively high. Real wages are positive, and so you have more imports. But exports definitely on the weaker side, and that caused the overall number to be weak. Here we have goods imports in isolation. We looked at both sides of the ledger in the last slide. This one we're going to look at imports. You can see here all-in number about 282 billion of imports. You back out technology, you can see that both of these series have witnessed upticks as of late. And over here we look at the aggregate trade deficit on a year-to-year basis, and you can see here that 2025 really matched up well with 2024, and we've posted some of the largest trade deficits over the last, call it 5 years, that we've posted in a very long time. And obviously you've got to go back to 2007, 2008, And then obviously, as the headline says here, you've got to go back a lot further to get to levels where we are right now. So where do we have some of these deficits, and who are they attributed to? Annual trade balance with China, as we can see here, due to tariffs and kind of this new Cold War, if you will, trade war. Those have dropped, whereas Canada, you can see drop there, but they're coming off of pretty high levels a few years ago. Mexico has definitely expanded. And again, these are two extremely important relationships. Those are our two biggest trading partners. And then, of course, Taiwan with semiconductors and technology, also very important and trending in I would say, kind of a non-positive way right now. On this slide, we have the Conference Board of Leading Economic Indicators. The index itself, at times, has been a fairly decent predictor of potential recession risk. Not so much over the last 5 to 7 years, however. We see here that the index itself, again, having said all that, continues to trend lower. The year-over-year change remains negative, and we're starting to build another string of consecutive months where that month-over-month change is negative. So the LEI is a compilation of a lot of different data points, and you can see here that they're both financial and non-financial. And so it's essentially a composite index of all these indicators. And you can see the things that are detracting right now, or you've got the average work week, you have new orders in the Institute for Supply Management, and we'll take a look at some Federal Reserve districts in a second, which might belie that a little bit, but we do know for a fact that consumer expectations are pretty weak right now. In fact, CEO and C-suite executive expectations look a lot better than the consumer expectations do. And then other things that are in the positive, ironically, we have building permits, private housing that's additive to this, and then you've got some financial components that are modestly, slightly additive to the overall number. Now we'll look at the Philly Fed Manufacturing Index. You can see here that number continues to move a little bit higher and is definitely in expansionary territory. You can see new orders also in the same boat, trending a little bit better. Again, very noisy data sets here, but you can see they've at times broken modestly through the break-even line, but on balance have remained fairly positive for quite some time. Here we have the business conditions component of that. You can see that continues to move higher. It's a very positive development, in my opinion. And then you look at employment, and that's still really kind of weak to flattish, we'll call it. Just not a lot going on in employment. Of course, we know that, and it is very consistent with some of the other Fed districts. Here's the Empire State Manufacturing Survey. So just as we were looking at the Philly Fed, this is actually the New York Fed index. You can see their index was a little bit more sluggish for a period of time than the Philly Fed was, but it's improved. It's been positive. Latest data point there is positive. You've got new orders, which are modestly positive. Shipments, which are roughly flat in the last reading. So takeaway here is that you've got some gradual improvement, but it's not a very an incredibly robust environment here at the New York Fed District. Now here's something I wanted to visit with you all about. So we have essentially U.S. debt, marketable debt outstanding of about $30 trillion. And we have almost 1/3 of that that's maturing in the next 12 months. And basically, we've got an original issue rate. So a lot of this debt is perhaps shorter term, and it was obviously issued at a point where interest rates were a lot lower than they are now. So in fact, average interest rate there, and a lot of this is short-term debt, is like half of 1%. Now, the current financing rate, as we know, is a lot higher than that, and we're talking about anywhere between 4.3, 5%. Let's call it even the low fours. So the issue here is that we have a third almost of our national debt that needs to be refinanced this year, and that refinancing cost, in terms of the higher interest rate, is going to cost us about $190 billion of incremental interest expense on that debt. So why is that important? Well, obviously, this has implications for crowding out government investment, and it's one of those things that is kind of like the silent killer that basically prevents the government from spending this money on other things because they are having to refinance it at higher overall interest rates. So the government sector, as we'll see here in some slides ahead of this, is definitely not in as good a shape as either the consumer or the commercial sector is. You can see here government debt as a percent of GDP. We know that we had a really large bump in issuance during the pandemic. Then we brought that down, and now we're back on the rise again with some of these expansionary policies. Again, the issue that ties us back to tariffs is that some of these assumptions that we'll take a look at in a second were predicated on the continuation of tariffs, and if those tariffs are not able to be implemented, or the average tariff rate is going to be lower, then that's going to put more pressure on funding of the government, which is, as we'll see in a second, is going to accelerate this. But again, you go back to the global financial crisis. There was a lot more fiscal responsibility here, and certainly from a deficit standpoint, back here we were actually in a surplus, but that has obviously changed. You can see debt as a percent of GDP moving materially higher. Here we have the forecast. This is by the CBO, the Congressional Budget Office, and like I mentioned, we've got debt that's roughly in line with GDP, but that's definitely going higher. And again, if you maybe accelerate these a tad, if you assume that tariffs are not going to be implemented, but spending is not going to be adjusted to the level of tariffs, and that spending continues regardless of where those tariffs are, this could look even worse. But again, this is something that the next generation is really going to have to wrestle with, because it's going to have more significant implications with regard to investment crowding out by the government, which government spending as a percent of GDP right now is, call it 12%-ish, and that might be a little bit lower. Not too many levers that the government can pull in terms of money savings, and I think particularly the Doge effort found that out, that there's a lot of hard costs that just can't be taken out of government, and obviously you've got the entitlement issue there, which is going to be weighing on the fiscal equation for quite many years to come. Here we have durable goods orders, and we back out the volatile transportation sector. Aircraft within that category can be very, very noisy. You can see that that was better than expected. A good data point. So these are durable goods orders. Here we have core capital goods shipment numbers. Again, backing out that aircraft and defense numbers, you can see that shipments looking positive here. So really, when you think about it, the developments on on some of these capital goods areas are actually pretty strong, and I think it certainly bodes well for the rest of the year. Here we have capacity utilization. We just talked about capital goods shipments being positive, but we've got utilization that's actually a lot lower. I think of kind of like target utilization over the many years that I've been in this business has been in that kind of that 80% range. It's usually around 80 where you start to see the need for more capital expenditures to increase capacity, because obviously you want some some buffer capacity for boom times, but but you don't want to be you don't want to be caught with you certainly don't want to be caught without having enough capacity to meet your demand. And so where we are now, we'll call it like 76.2 here on this latest reading. That's still pretty low. So we have more room to go before I think we really see a significant capex boom. Here we have freight shipments, again, moving lower. You've got freight expenditures roughly flat, so indicative of what's going on here with trade. Here we have the housing market index, still pretty low. We've gotten a little bit of relief on mortgage rates, now around kind of 6%. Some of that has to do with a narrowing of the spread to U.S. Treasuries, and so we'll have a little something on that as well. But overall, home builders index still looking pretty weak. Now we'll shift over to the equity markets. This is the S&P 500 revenue growth, and by all accounts, fourth quarter was very strong. Again, it's not anything I would have expected, heading into the second quarter of the year, but it sure turned out that way. In fact, if you look at it from a sequential basis, going from first quarter to fourth quarter, we had some pretty strong acceleration in growth that we haven't seen in quite some time. So the overall top line backdrop for the S&P 500 very strong. Obviously, a lot of technology influence here, but again, if you're just tracking the index, you have to, probably walk away a little happy with that. We'll talk about earnings for a little bit. Here we've got year to date sources of equity return for different markets around the world. You see that most of these are going to be delineated by either earnings or valuation. You can see that here in Japan, for example, we've had a huge valuation increase with some of the things going on in Japan. We've also had some earnings growth. You can see the emerging markets in Asia ex-Japan have had tremendous growth in earnings, even if they've had multiple contractions here. UK and Euro area benefiting from both multiple expansion as well as positive earnings. And you can see here year to date, US in terms of total returns year to date, we don't have really much to show for here in the US, but and that's primarily because we've had some multiple contraction. And again, these two levers work in tandem to provide total return. Obviously, you can have earnings growth that's moving higher at the same time, as is the case in the U.S., where valuations are contracting, and so you really have no net gain in overall performance. But clearly, you can see some of these other areas, the emerging markets in particular, are doing exceptionally well, even if they have a little bit of multiple contraction. They're having an earnings blowout, and that's leading to outperformance relative to the rest of the world. We will now take a look at what the forecasts are showing us here for the remainder of 2026. You can see the various components of this expectation kind of built into this one particular chart for various areas across the globe. Let's just start here with the S&P 500. So we're looking for, at this point, and this may be a little conservative, 10 percentage points, basically 10% earnings growth. And then we get a little dividend yield on top of that. Overall indices are a little bit higher, so the dividend yield is not going to be as much. So add on 1% for dividend yield, 10% for earnings growth, and expected to have multiple contraction through the year, which is very consistent with all these areas that have appreciated greatly over the last 3, 4, 5 months. So multiple contraction, and you add up earnings and then dividends and then subtract that multiple contraction, you get a total growth for the year expected to be around 7% for the equity markets. And you can see here, Europe ex-UK about 5%, again, also with multiple contraction here, but positive earnings growth. And where you really see the juice here is in emerging markets, where even though you get that multiple contraction, as we saw in the year-to-date numbers in that prior slide, you're still getting really good earnings growth and you're getting a dividend yield on top of that. And so the net of all of that is 8% expected in emerging markets. So very important to be diversified there because that return, that expected return for 2026 actually outpaces the US and for the rest of the major markets for that matter. So even with the multiple contractions that we're expecting here for all these major markets looking into 2026, we're coming off of a higher point right here. You can see a forward price to earnings ratio for the global environment, ex-US, as well as the US markets. You can see both of these multiples have kind of taken an uptick here. You can see that multiples, by and large, just over a longer period of time, have trended higher. That sets the stage, obviously, for more volatility, perhaps, but I think this is one reason, this more recent appreciation is one reason why it's reasonable to assume that we could have some multiple contraction, because I certainly don't see these moving considerably higher from levels where they've already accelerated to. So again, very plausible argument that we might have some multiple contraction given the fact that these are high and have moved a lot higher here in a very short period of time. Very interesting here, we've got demand for treasuries at a pretty high level. And you can see here, this is the 30-year bond auction results have been very, very robust. So we've had basically a surge in indications here. And so you think, what does that do for interest rates in the bond market? So when you think about it, the levers that get pulled here, you have increased demand, which is going to drive up the price of treasuries, which is going to help keep the yields lower. And so this has the effect of compressing yields in some spots. And here we're actually talking about the 30-year. So those longer term yields are going to be basically capped for the time being, as long as this demand for treasuries remains strong, which in and of itself is a symptom of people looking for the safe haven amidst geopolitical tensions, perhaps some fiscal concerns, etc. But positive to see some pretty strong demand for U.S. Treasuries. So we talked about the government sector's balance sheet not looking so great, all right? And we talked about the trajectory, which really is problematic from a federal debt to GDP standpoint. Now, switching gears and talking about households, I mean, we've seen a fairly consistent decline in household debt as a percent of GDP going back to the global financial crisis. And you can see that continues to move lower. So I could say from a relative standpoint, or certainly relative to maybe the advent of the tech bubble back here, which is the last time we saw debt to GDP numbers this low, that we've done a fairly consistent job of deleveraging at the household level. And as we'll see here in just a second, businesses are in good shape as well. Here we have non-financial corporations debt as a percent of GDP. In some respects, it looks very similar to the consumer side. We've got these debt levels that are moving much, much lower. And you can see how these debt levels oscillate to the point in the economic cycle, and that these peaks have generally been associated with recession periods. So obviously everything's moving down right now, so you tend not to see recessions in the middle of declining debt. Again, commercial sector in really, really good shape. Now we need to talk about private capital here. So not only have we seen some pressure on private capital publicly traded firms, which we can see here: Apollo, Blue Owl, Ares Management, Blackstone, TPG Group, and KKR. We've seen pressure in all these stocks. Really, the main reason is that you've got a lot of private capital that's being lent to the software industry, and a lot of people are now concerned with capital spending. We'll take a look at that in a second, but you're almost being penalized if you have fairly rapid capital spending plans. And we know that a lot of the capital spending is coming out of the technology sector. And so, there's a fear that we're going to have a little bit of a credit issue. Again, we don't see it in the data. And if you look at the net asset value for all these entities, and even the business development companies, the BDCs are under pressure now for the very same reason that, there's a fear that there's going to be a big credit problem. And right now, we don't see it being a catastrophic problem, but rather something that can be easily managed through. And I think that these things are getting oversold, but again, it does pay to stay on top of the credit profile of all these, non-bank sectors, and because a lot of these loan covenants are actually pretty stout, and and they're almost stricter language in some cases than you see with bank loans. Here we have hyperscaler CapEx, as I promised you in earlier slides. This is rising at a exponential rate, and again, I don't know that this is sustainable, but you have basically $650 billion of capital spending on the part of these players right here. And there was a time, 2024, 25, when this type of rate of growth was welcomed by the market because they could see, additional AI benefit coming out of it because you've got more, computing power that's being funded, so on and so forth. Well, fast forward to 2026, and that's now becoming a bit of a headwind as people are growing, in some circles, concerned that we're spending too much too soon. Here we have tech sector, and kind of dovetailing off of the comments there on that last chart, or a couple of charts here. We've got credit default spreads on technology firms that have widened out quite a bit over the last several months. You can see here very clearly that the risk profile that's being assigned to the tech stocks has certainly come unglued with the more recent trends. Here we have a depiction of where we are with interest rates. And amazingly enough, and we just talked about how we've got a third of the Treasury base stock of bonds that are going to have to be refinanced over the next 12 months. In a very similar way, we've got a lot of debt outstanding. In fact, 90% of it almost is below 5%. So, you think, what are the implications here? Obviously, if some of that needs to get refinanced, then the chances are that it's going to be above 5%. And also, there are other implications that are tied to, the dollar, the weakness of the dollar, and the competitive of these returns on a currency and currency weighted basis. But again, you look at what's coming in the future. And we're going to see more of these older loans drop off in favor of these higher interest loans. Here we have unicorns. Very interesting here. This goes back to the whole valuation of technology companies. But again, I'd be clear and want to be clear in saying that when I refer to unicorns, I'm not just talking about tech firms. In fact, I'm talking about a lot of different industries here, but you can see here that with valuations being fairly strong, really coming out of 2022 and then kind of rising in 23, 24, and then obviously last year, that it doesn't surprise me that you've got more of these, private companies, growing private companies that are worth over $1 billion. Here we have crude oil stocks. We do see some geopolitical influence on these numbers as U.S. has moved a second carrier strike group to the Persian Gulf. But you can see here crude oil stocks remain at the lower end of the 5-year band. You can see gasoline stocks are a little bit higher. So, we've seen a little bit of relief at the pump lately. That actually changed, rather dramatically from the end of the year. And then distillate stocks, heating oil, you've got kerosene. You've got a lot of different things there, also at the low end. So, you kind of add all that up, and what does that get you? You've got gasoline futures moving a little bit higher after having come down January. You've got increased geopolitical risk, which is increasing the freight rates for your VLCCs, which are your very, very large crude carriers. These are the largest tanker ships out there, and these rates are moving to what's noted here is a 6-year high. Quick comment on cryptocurrencies. You have this particular index here, which we've looked at before, the fear and greed index. So, we've reached a real high point in fear. We've seen a tremendous amount of volatility in the crypto space, and you can see that that's depicted here. Now, and we've also seen a tremendous amount of outflow from cryptocurrency ETFs. And it just really wasn't more than a couple of years ago that we saw the kind of the breakout in some of these new products that could be used. But right now we're seeing a lot of outflows. So there's a very negative sentiment on cryptocurrency right now. That's all the slides we have this week. Have a great week. We'll talk to you again soon.